everyone, and welcome to another Edge Capital video podcast. Today, we'll be focusing on portfolio construction, risk management, and what it takes to generate an edge in today's digital asset markets. I'm Kalafsky. I focus on investor relations at Edge Capital, and I'm pleased to be joined today by Robert, head of research at Edge Capital. Before we begin, a quick disclaimer. This video is for informational purposes only. This is not investment advice and not an offer to sell or to purchase any securities. Please refer to the full disclaimer at the end of the video. Robert, thank you for joining us.
Thank you, Caitlin, for having me.
Let's start with broader market environment. How do you view the crypto market today? What does the current environment look like, and where do you think we could be heading from here?
Yeah, sure. Great question. So I believe, with the current price dynamics, of course, the general market sentiment is that we're in the bear market. So the prices are going lower, the valuations are extremely at low values. And basically what's happening is that the market is trying to reassess and to reinvent itself. It's just trying to understand which valuations are more appropriate for tokens overall. While fundamentally, I think everything stays pretty much same, and fundamentally, all the indicators and all the data is showing us that the market is extremely strong. And I do believe, we at Edge, we're still long-term believers into the industry. So if we look at the data specifically, for example, we could look at the stablecoin supply, and we could see that the stablecoin supply is growing up more and more with each month, which is quite interesting because this is not a typical story for the bear market. Because, for example, in 2022, after the Terra Luna collapse, after the FTX when FTX happened, stablecoin supply went lower, and it took a couple of years for the stablecoins to get back to the previous levels. While here it's growing up insanely high. What it means that the usage of stablecoins is increasing. Fundamentals are getting stronger and stronger, and the adoption is here. So basically, the world, the general users are minting stablecoins just to do the daily transactions, and to flow in, which flows into the revenue of the chains and of other crypto projects. While at the same time, if we look at the derivatives data, we could see that it's not showing you the best picture, since the open interest is going lower and lower. For example, on BTC, open interest went more than twice lower, which is extremely which is unusual, and probably this is what the bear market should show you. And at the same time, we are having extremely low funding rate values for BTC and for other crypto derivatives, which shows that basically everyone is trying to close their leverage longs, and they're opening the leverage shorts, and the short sellers are ready to pay for their shorts, which is very unusual. And usually the tendency is that if we're having a very low funding rate, it means we're unlikely to go lower. And the same for the reverse. If we're having a very high funding rate, we're unlikely to go higher. So basically the market is showing us a very contrarian signs here. If we also look at the options skew data, which shows us that currently puts are priced at extremely high level comparing to calls, means that the market is ready to overpay for puts compared to the call options, which means that there is a lot of puts in place, right? And usually it could show us pretty nice short squeezes on the way up, which is actually happening currently as we speak. So like today on March 16th, the market is going up like by a few percent, and like there's large liquidations happening in place exactly because there's been a huge accumulation of shorts, of bears in this market over the past month. And another quite interesting indicator is the crypto fear and greed index, which is basically like it's clearly showing that we're at all-time lows. This indicator is showing us that people are no longer interested in crypto. They're not discussing it in the social media. They're not believing in it. They're not holding it, which means that basically at this current valuation levels, everyone who wanted to sell, they already sold, and everyone who are holding, they would hold their crypto anyways, right? So we don't have any sellers, and we only have people who sold on the way on this way down. It means they would be rushing into the market as soon as the market would see some revival. So basically, in short, if I would summarize everything which I said, fundamentals are extremely strong. The adoption is increasing overall, like around the world. The banks are preparing the crypto rails to facilitate like any sort of crypto-related transactions. The TVL is also on the steady way, and derivatives are showing us that we might face some short squeeze on the way up. So under the normal environment, of course, if we wouldn't see any geopolitical shocks and crises getting worse and worse, like we have a pretty much strong bullish thesis on the next year.
Thank you. Let's shift from the broader market to how you think about managing capital within it. How do you approach portfolio construction in digital assets? Specifically, how do you think about allocating across different assets while managing concentration risk?
Yeah, sure. So at Edge Capital, for example, we have a very strict risk management framework, which is basically telling us that we have a specific tier system for each of the exposure which we have. So for example, we have like some protocols which are tier 1, which are tier 2 and tier 3, and we have some stable coins, some exchanges which we're also trying to separate into the different tiers, and we're trying to work within the limits which we put ourselves under each tier. So for example, on like specific tier 1 protocol, we cannot have like, for example, more than like 25% of the portfolio invested, and like into another protocol we cannot have like, which is like, for example, tier 3, we cannot have more than like 5% invested. And at Edge, we're trying to create a very risk adjusted portfolio where we're trying to allocate into like specific tier 1 and tier 2, tier 3 exposures, while of course like tier 1 exposures might give us less yield, while tier 3 exposures will give us more yield, since we need to get a certain kind of like risk premium for each level of risk which we take. But overall, we're trying to work within those limits, which helps us essentially not to be concentrated on this specific protocol, right? And of course, we do some risk modeling, we do some scenario analysis, because a lot of protocols are very their risks are correlated, right? If one protocol is hacked, it might mean that another protocol might be hacked as well, because they're kind of like similar. They share similar economic logic, or like they share similar smart contracts. So that's what we're trying to manage at Edge.
Liquidity can become a major challenge in this market, particularly during times of volatility. So how do you manage liquidity in the portfolio, especially during periods of market stress or investor redemptions?
Yeah, that's a good question. So regarding the liquidity, we run a solely market neutral strategies. So we do not do any like token investments, any venture kind of investments, any private private equity deals, which means that all our positions are extremely liquid. If we want to, we could basically close all of our trades within maybe like a couple of weeks with minimal slippages. We could close everything within less than a week with relatively high slippages, right? But still, everything is extremely liquid. We run a lot of basis trades. We run a lot of perpetual futures arbitrage trades, and a lot of DeFi yields. So all these trades are quite liquid. We are not investing into any like smart contracts with hard lockups, into any, like as I said, into any private deals which are requiring some kind of like lockup of assets. So in this sense, we have very structured portfolio, which gives a unique kind of a blend of the high yield and liquidity.
Management has also been a major focus for many managers following the 2022 cycle. What is your drawdown tolerance, and how has your risk framework evolved since that period?
Yeah. So regarding the drawdowns, I would say like it's not fully applicable to our portfolio, because like investors and like in general, our portfolio and our strategies are resembling more like a fixed income portfolio, because we're not seeing a lot of drawdowns in the portfolio, but the risk which we take is essentially a default risk, right? So when we invest into some smart contract, we're expecting to get some kind of a yield, but there might be some black swan events due to which the smart contract can be hacked. Basically, the private key can be mismanaged or something like this. So this is essentially like a good comparison in TradFi is a default of the company, right? So we face this risk, and like we are trying to do our best to manage it, right? So we're doing so as I said previously, we are diversify a lot. We're trying to buy insurances. We do a very deep in-dive due diligence on the protocols where we invest in. So we're really trying to minimize this risk. But in the traditional kind of a sense, we're not facing any drawdowns, right? So when the market is going down, like for example in February it went down like 30% down, I think all our investors really appreciated that they invested into market neutral fund, right? That they did not have any kind of drawdowns in the portfolio. What we did, we only like kind of like we had less yield than the previous month, for example, but no one really cares about it when the market fell down 30%, right? So and at the same time, like when the market would revive, we would make higher yield. This is essentially the investment, the core investment thesis at Edge.
Okay, so let's turn to strategy and competitive advantage. In a market that is becoming increasingly competitive and institutionalized, what do you believe is your true edge? Is it research, market access, technology, relationships, or some combination of the factors?
Yeah, honestly, I would say it's everything mentioned here. Of course, as a head of research, I should tell you that it's a research, but honestly, I do really think we have set up all the processes within the company at extremely high efficient way. So we have a very efficient risk management policies in place, which helped us a lot, avoiding a lot of turmoils in the past years, right? So the fact that for the last 5 years we haven't had any major drawdowns, unlike some of the other funds which might not be operating right now due to those. It showed that we really have very rigid policies in place. We also have a very unique relations with our counterparties within the industry. So I believe we are quite well known on the institutional side within the crypto space. So we know a lot of major players in the space, so which really helps us with the investment approach. It helps us getting some kind of unique knowledge, which helps us understanding the portfolio, the markets, and everything else. And of course, regarding the research, I think we have one of the more kind of deep dive due diligence processes across many other players in the industry. So we're really trying to understand the protocols where we invest in, from the economic risk side, from the operational side, from the smart contract side. So we're trying to make due diligence on each and every side of the protocol where we invest in, and we're always trying to hedge our risk with the legal contracts which we write in place. I would say the combination of all these factors gives us a very unique edge, which we're due to of this, we're trying to achieve the best yield for our investors.
Speaking of investors, from their perspective, how do you differentiate your strategy from a simple passive allocation to BTC or ETH that an investor could implement on their own?
So of course we're not giving to the investor same kind of a yield, right, or returns which Bitcoin or Ethereum are offering in the long term, right? Of course we're long-term believers of into the crypto industry, and hopefully Bitcoin will pass $1 million in price, and everything will go up a lot. But at the same time, all investors clearly understand the volatility of those assets, and basically many of big institutional players, they are not willing to tolerate 20, 30, 50, 80% drawdowns in their portfolio. So that's why they're trying to achieve a unique exposure to crypto industry, right, to the crypto return, but without the crypto volatility. That's how they invest into us, right? So we're basically our returns are somewhat correlated with the crypto industry, because like I said before, when market is going down, we're not making a lot of yield, but when everything is going up, we're trying to achieve the best yield for our investors. So for example, in 2024, where there's been a lot of hype, a lot of there was a clearly bull market, even though Bitcoin performed a lot, we still achieved about 30% plus yield for our investors in that year. And basically in 2025, when Bitcoin went down, when Ethereum went down, we still didn't lose any money, and we still made a pretty significant yield compared to what if they would have invested into those crypto assets. So in short, we're proposing a consistent yield to the investors with much less volatility. But of course, if the investors are high believers into crypto assets, they're simply holding their bitcoins and the crypto assets within the fund, right? Which is another share class which we're offering for that kind of investors.
Thank you so much for your time, and thank you for sharing your perspective with us today. And thank you to everyone for joining us. Please stay tuned for our next interview in this series.
Thank you.